Mr. McCully owns the McCully Group, LLC, a firm that has provides strategic consulting services to dairy and food companies. The McCully Group has worked with many of the top dairy and food companies in North America, as well as major global food companies. Client projects include business analysis, procurement and supply chain strategies, market research, and commodity risk management. In addition, the McCully Group has provided subject matter expertise for global consulting companies, private equity firms, and Wall Street investment banks. Mike has spoken at numerous conferences around the US, Europe, and Asia. Prior to starting the McCully Group, Mike worked for over 15 years at Kraft Foods, where he held management roles in dairy, meat, and grain purchasing. Mike has worked on many dairy industry issues and served on the board of directors for International Dairy Foods Association Milk Industry Foundation and the Dairy Institute of California, and is currently a member of IDFA's Dairy Ingredient Board. He has also been a member of IDFA's Legislative Outreach or Oversight Committee, IDFA's Farm Bill Committee, the National Cheese Institute's Economic Policy and Legislative Committee, and the California Dairy Institute Producer Relations Committee. Man, Mike, you serve on a lot of committees. He is also a member of American Dairy Product Institute Center of Excellence. By the way, I don't know if any of us envy you for committee work, but it is important. Thank you. Thank you for your service. Mike grew up on a grain and beef cattle farm in north central Illinois and remains active in the beef industry through his partnership in purebred Angus and Hereford cattle. He has a bachelor's degree in agriculture from Western Illinois University and a master's degree in agriculture economics from the University of Illinois. Welcome, Mike, and thanks for being here today.
Thank you very much, Ben. I guess the first thing I need to do is probably shorten my introduction. That probably too long there, but appreciate that, and also enjoy the opportunity to come and visit with you here today, at least virtually. And what I'd like to do is, as Will did a great job kind of sharing his, kind of where we're at in terms of, globally. What I want to do is focus a little more here on the U.S. And obviously, as Will mentioned too, is, we are in a global market. So there are things that happen outside the U.S. that have an impact on U.S. prices. And as we've seen, I start here on the first page with a black swan. And I think 2020, if you look at the definition of a black swan, 2020 has definitely fit that. If you talk about something that is, a situation that can have severe consequences, it's usually not, it's pretty much off the charts in terms of not being expected. And what we've seen here is, pretty much everything you read here, maybe except for that last couple words, and you can even debate that. What we've seen here in 2020 has definitely been a black swan event. And I think it's interesting early on, said it wasn't necessarily COVID was the black swan event. It was actually government shutting down businesses was more of the black swan. And I think that, to me, in my mind, is probably a little more appropriate way of looking at it. So what we've seen here in the dairy markets in the US, and I think, what Will showed gives a good contrast to what we've seen globally. But the US has really seen a lot of volatility, and particularly in the cheese market. From April to July, we saw $1, which was the lowest we've seen over a decade back in late April. And all of a sudden, with a whole number of events came together to see cheese prices shoot up to $3. And for a point of reference, the previous record high of block cheese price was around $2.40. So we didn't go a couple cents above the previous high. We went 60 cents above the previous high, or 20% higher than the previous record high in cheese prices by mid-July. And then back down we went a couple days in the 150s. And then here comes another food box deal and from the USDA, and off we go to the races. And I would say I and as well as most other analysts at the time said, boy, probably don't need to go much above $2. Oh, and now we're back up to 280. Again, point of reference of 240 being the prior high. So twice this year we've seen two different rallies that were well beyond anything we've ever seen in the cheese market. But now we're back down, and this is I wrote this yesterday evening. I had to check the market right before I got on. Blocks are down another like 14 cents or so today, down to $1.77. So just over $1 drop in a matter of a couple of weeks on both block and barrel cheese. So we'll talk a little more about that here in a few minutes. But again, just unprecedented volatility that we've seen in cheese. Butter, this is one that's kind of taken it on the chin when it comes to food service sales. There's a lot of butter that's sold in restaurants, particularly full service restaurants, upper end restaurants. And those largely have been restaurants that have been closed or suffered severe downturns in business due to the lack of business travel, conventions, conferences, things like that. And the outlook here isn't very good. And then finally, on the other major product we'll talk about is milk powder. It's been relatively stable. And I think we've got pretty good demand around the country in the US. Domestic demand has been pretty decent, recovering here recently. Export demand, as Will showed, is quite good. And higher global prices help there as well. So I think if I didn't put a black swan on the first page, I would have put Goldilocks and the three bears and the three bowls of porridge, because you've really got a hot one and a cold one, and one is just about right. Cheese has been hot, butter's been cold, and milk powder has been about right. So as it kind of look out to the next year, I think it's kind of depending on your timing, your perspective here in terms of you're looking next couple of months, next couple of quarters, or out of all of next year. In general, I would say I think we're going to see some lower dairy prices and milk prices in the first half of next year, but I think the second half of next year is set up for a pretty decent recovery. And I think the magnitude of that recovery is going to depend on a couple of things. One is obviously the news here the last couple of weeks or a week or so with looks now a couple different COVID vaccines. Hopefully got more of that coming. If that happens, we see that widespread use by second quarter, middle part of next year. I think that's definitely positive for demand. I think we've just seen it in other, particularly the equity markets or stock markets here in the last week. I think it's just lifts everybody's spirits that we can at least see the light at the end of the tunnel now. It is we still have a ways to go between now and then, but I think that is generally positive. I think the other thing we're going to see is a slowdown in milk production. I think in the U.S., I think the combination of lower milk prices and higher feed prices or costs will start to bite into the growth rate, and we'll talk about that more here in a minute or so as well. The growth of milk supply growth here in the U.S. is trucking along pretty good. 2.3% growth in September. As Will said, we'll see October's numbers here in a day or two. That's plenty of milk. And if you look back over the last 6 years, I could actually go back over the last 10 years or so. That's at the upper end of what we see in terms of growth rates. On average, you're looking at about 1.5% growth. And my rule of thumb has always been, if you get under 1% growth, it's probably not quite enough. You're going to see higher prices. You get much north of 2%, that's going to be a little too much milk, and you're going to see lower prices then. So, and this is also, I also liken milk to a big faucet. Takes a long time to turn the faucet on. Takes a long time to turn it off, and we're in the process of turning it on pretty good back in the spring. When COVID hit, basically got both feet on the brakes with the supply management programs, and remarkably, the industry slowed milk growth like pretty much we've never seen before. But once we got into June and July, and all of a sudden the last couple of months, we're back in recovery mode, and we're getting back close to that growth rate that we saw back in March. So I think that's going to continue. It really is a tale of different farms and really different parts of the country. I'd say in general, the eastern part of the country is doing pretty well here in terms of milk production and overall profitability. And maybe some of you will disagree with this, but talking to several of the co-ops in the eastern part of the country in the last couple of weeks, given the amount of government money, DMC, maybe DRP, insurance or risk management deals, in addition to the recovery in milk prices in the second half, they're saying some farmers are going to have as good or maybe the best year they've had this year by the time they put all of it together. One co-op I talked to last week, they've already got farmers pushing or deferring payments, milk checks, and out to January, which tells me that, and that started in September. And that tells me that farmers are doing pretty well there, at least in that part of the country. An hour or two later, I talked to folks out in California, and they're crying the blues over low milk prices. The lower milk powder and butter prices have hurt them much more than it has in other parts of the country. And given their low class 1 utilization, they just haven't benefited from that. So it really kind of depends on where you're at. I think the last one I'll mention here on this page is that we're not seeing maybe them hit yet, but starting to hear some talk or questions in the last week or so about the reimposition of these supply management plans, and maybe not everywhere, but there are areas of the country that have plenty of milk or too much milk. Pacific Northwest, specifically Idaho, is pretty much been full of milk for a while. California, talking to folks there in the last, like I said, even this week, they're saying we don't know what we're going to do with all the milk come next spring. The Southwest, they did keep some supply management programs in place given the amount of milk growth down there. The Northeast has been long milk. So I think you're going to start seeing a few more of these put in place, or let's say maybe they've been in place, they just haven't been enforced as much. And I think just I think the combination of lower milk prices and the looks like a upcoming mini wave of milk coming at them by next spring is enough to maybe put these back into effect. And I would say, to the credit, co-ops as well as some of the private plants did learn a lot from this spring. And I'd say in general, we learned a lot from COVID, and what we can do in supply chain. And I think the ability to shut milk off pretty quickly or turn that knob back down is one of the key learnings from it. And I think it'll be something that'll be used more going forward. We talked about cheese specifically. I've said prices are in free fall and they continue that today. The good news is barrels at least got a foothold. They dropped substantially yesterday down to about $1.40, and block prices, like I said, today they dropped another 14 cents or so. I think they were at 191. They're down to 177 today. So again, to put that in perspective, from November 2nd, we've now seen block prices drop $1 from where they were. And barrel prices are down $1.13 a pound, or that's almost 45% of their value since November 2nd. This is, I believe, if you compare this to any other commodity, ag commodity, even non-ag commodities, cheese, I believe, has been the most volatile of any commodity this year. And you can see the huge swings in prices from back in the spring up to, this is weekly numbers, so at a daily, we would see $1 to $3 range back in the 150s, back up to 280. Now we're back down to 177. I think, if the market could finally find an equilibrium point here, which I think the price wise, I think we're there. I think my outlook is, if you look on the bottom part of this page, is we settle out here kind of in the 170s, give or take a dime. Futures markets for next year point to a mid 170s market, very flat structure. I'm sure that'll be wrong. I think we'll see some lower prices in the first part of the year, down around 160, and we see a recovery in the second half of the year. I think could easily be 175 to $2 cheese second half of next year, and if we have any supply problems, even north of $2. So what we've seen, the combination of the COVID lockdowns, the renewed concern over that, in addition to more supply and buyers backing off, have seen prices drop substantially here. There's, as Will showed, global prices are around $1.70. So at some point, fairly soon, the U.S. will get more competitive and back in the export market, which will be helpful. In general, if you look at the demand here in the U.S., retail demand for cheese continues to be very good. That's been the case all along. We continue to see 10 to 15% growth year-over-year sales in retail cheese. And a lot of that has been the cheddar cheese, the shreds, the slices, and things like that, which has been very supportive to the CME block market. The other thing that's been very supportive to the CME market, or the block market in general, has been all the buying for the USDA food aid boxes, really since back in the springtime. I think we're about at the end of those. Supposedly this round 4 that was announced just ahead of the election was going to go through the end of the year. I believe that's about the end of them. It's a very common question, is there going to be more of them next year? I think there's 2 things to look out for. One will be next month. If there is a stimulus package, there's likely going to be some sort of food aid put into it, would be my guess. Is it a food box deal? I would guess no. I don't think it's a 0 probability of more food boxes. I think it's a fairly low probability of them. My guess is definitely the House and the Democrats definitely prefer putting money into food stamps, getting it directly out to people that need it. In the Biden administration, I think you'll see a much more focus around SNAP and food stamps. And I think the food box deal is probably done. On the bearish side, we talked about milk supply growth. I think we've got a lot of uncertainty going in the winter, as we talked about with restaurants. Now, the one good thing for cheese is it does outperform, I would say, other dairy products. So you think, roughly, not quite half of all cheese domestically goes into pizza. or the food services pizza, and they tend to be more favorable in terms of carry out and delivery if people are shut up at home. So I think they'll be okay. The QSR, the quick service restaurant business, and the McDonald's and those sort of folks are doing relatively better than the overall restaurant business, but still down some. So I think there's, again, a lot of concerns there. And then finally, on the supply side, we've got a new big plant that just opened up here in Michigan, the Glambia plant, and Midwest Cheese. They're putting out a lot of cheese, and it's going to be more and more going forward out in the next spring. So that is going to be a bit of a counterweight to the growth in some of the demand that we see. So that's been the hot market, although it's cooled off considerably in the last few weeks. Butter's been pretty cold for a while. Butter prices typically would see a uptick at this time of the year, October, November, going into the fall holidays. High fat products, they think eggnog, think creams, dips, cream cheese, all those sorts of things. Butter, a lot of butter sold here for baking and entertaining, and we're probably not doing a whole lot of that. And now getting more and more guidance about, you probably shouldn't get together with your family for Thanksgiving, and what are we going to do for the end of the year for Christmas and holidays at the end of the year. And so there's a lot of questions, I think, problems for the butter market going forward. Retail demand's very strong and will continue to be very strong, 20+% year-over-year growth, that they're going to see a lot of people continue to stay home and bake and do those sorts of things. But it's the food service has been really the problem here. And I think, overall, the net of all this, we've got stocks that are very high. Butter stocks are very high. You can see one of the bearish points I put down here. End of September, butter stocks were 18% above last year. We're talking about a butter market that is, I'd say, under pressure, particularly as we get into this time of the year, as we wrap up that holiday ordering, and we get into kind of a dark period where there's not a lot of features or a lot of demand coming up. So I think the market's going to be under pressure. You see my forecast down in the lower right-hand corner in this graph. That low bar in February is $1.25. It's back in the springtime, butter prices dropped down to about $1.10. I think $1.10, $1.20 is something that is in sight here. I think we're going to see a lot of old butter that's going to be hitting the market over the next couple of months, and I'm not sure if there's going to be enough demand there to offset that. The good news at some point is the higher global prices, which are up $1.70 or so, will help out. That will help clear some of the butter out of the U.S. It's a relatively small amount, so and it's not like the world is short butter either. So we're kind of long fat, not only dairy fat, but I think other fats in total. And I said, until the restaurant business comes back into particularly full service restaurants, which is probably out in 2022 or so, that the butter market's going to struggle. You notice, we went 4 or 5 years or so of hardly any time under $2. I don't see north of $2 in butter until we get out into 2022. They'll just have too much stocks weighing on the market until then. And then the other one is talked about is it's a very balanced market is around the milk powder. You can see we had a big drop back in the spring, pretty much a recovery, really kind of stable prices. New Zealand is the blue line, the middle line is Europe, the red line is the US. That's helped the US be relatively competitive there in exports, as Will noted. And we've been kind of stuck here between $1.05, $1.10. The GDT out of New Zealand, that number was a little higher this morning. So I think that'll be a bit supportive. I think overall, it's pretty much a range-bound market. Right now, we've got a little upside. We kind of run out of gas on that, and it'll drift back down. If you look at my forecast on the bottom part of this page, I think there will be a continued recovery of non-fat prices as we go through next year. $1.10, $1.20 roughly is where I'm thinking where we're going to see prices. It's a little below the 5-year average. But we've got, I think, overall good buying interests. We talked about China, talked about some other countries, and stocks were down versus a year ago. The problem here for the watch out, or there's a couple of watch outs, as we look at this market, production of milk powder was up 11% versus a year ago in September. And you've also got more milk heading to dryers right now, seasonal uptick in milk production, drop off in demand. I think also a watch out is schools. If you have schools that are not going to be in session, where's that milk go? Likely goes to a dryer, likely ends up in non-fat dry milk. So that to me is probably one of the bigger watch outs for the non-fat market here over the next couple of months. Like weakening global prices, again, saw a little reversal here today. So I think we're pretty much range bound. And then the last one, and we'll do talk a little about, is India. They've got a lot of milk powder stocks they need to get rid of, and they don't really have any trouble. They don't have any trouble putting subsidies on them to move them out of the country. It's a pretty good amount of milk powder. We, the U.S. could lose some sales on that going forward. So that is something to watch out as we go into Q1. Kind of bring all this home, kind of, if you're not used to talking about cheese and butter and non-fat prices and you're more interested in milk prices, as I said, I think we see a decline as we go, coming out of these really high prices. The top graph is class 3, the bottom graph is class 4. We've got these, super high prices, near record high prices for class 3 that we'll see in November up, 23 and change. And then we're going to drop off considerably as we get into December out into next year. My forecast is actually a number that it probably isn't very welcome, down under 15.75. That's almost, not quite $3 lower than what we're going to see this year. I think the first half of the year is going to be pretty tough. It's probably going to be, break even or below break even in terms of overall milk prices. And that is one of the things I look at, that we're probably going to see some dairy farm margins squeezed pretty tight in the first part of the year. And we'll eventually start turning that, like I said, turning that dial back on milk to see less milk as we go through the middle part of the year out in the second half of the year. Class 4 situation, I think it's going to recover from this year up not quite $1 or 100 weight. So you net all this out, I mean, 15.67, 14.24, your midpoint, you're 15-ish or so on your combo between the two of them. You throw some premiums, your class 1 and stuff in here. You're probably looking at a $16, $17 market for the year, worse in the first half, higher in the second half of the year. So I think, there's been a lot of heartburn over negative PPDs. Probably going to see that continue here for a little bit, not nearly to the degree, though, of what we've seen here back in the summer and here in the fall as well. So that's going to be better. And in terms of, like I said, wild cards, Will showed some in terms of globally here in the U.S. I think that dairy farm margin picture is going to be a concern. There's a question about the soybean meal prices. Yeah, it's up, $300 to $400 a ton. And what can we do? I think what we can do is hope that Brazil and South America has good weather and a good growing season to get a good crop down there to cool off the bean market. If you're buying it, if you're just selling beans or raising beans, it's all a good thing. Weather in New Zealand this time of year is always a focus. They are in La Nina conditions. So if any hiccups with their weather tends to have an impact on the global dairy markets, which will impact us as well. We talked a little about the supply management programs here in the U.S. and those are likely going to come back at least in some parts of the country. COVID recovery, I think it's a question mark. There's a lot we don't know yet going forward. I think there's a lot we've learned, but there's still a lot we really don't know in terms of how this is going to play out over the next couple of months. And I think there will be some government support next year for agriculture. There was a lot this year. I don't think it's going to be quite as substantial as we get on to next year. I think that, frankly, the need will probably be less in total. And if there is a light at the end of the tunnel, they're going to be probably a little more reluctant to spend tons of money on it. And I think for dairy, it really does come back. A lot of this is around restaurant demand and food service demand. If we can see that recover, we'll be in better shape. But until then, it's going to be kind of tough going, I'm afraid. So with that, again, appreciate the chance to visit with you, and I'll turn it back over to Ben and see if there's any questions.
Yeah, thank you, Mike. We appreciate your presentation, all your information. If you have questions for Mike, please put those in the Q&A box below. Mike, I did have a couple of questions. First off, I guess I'm kind of in agreement. Soybeans and corn is kind of my thing, and so we've been spending a lot of time looking at the soybean meal market. When I think of an La Nina year, South America, especially Argentina, tends to have a shortfall in soybean production, about 9% against trend. When we start looking at Argentina provides 43% of the world's soybean meal demand. Couple that with maybe decreased driving and ethanol production here in the United States, lowering dried distillers grains. To me, the soybean meal picture looks very bullish on the price side going forward. Maybe you all would disagree with it, but that's just, I guess, my analysis. Quick question, Mike, kind of tied into that is, we saw, you mentioned the prices kind of decreasing for milk producers, plus then the increase on the feed side. But we've seen the counter with these large government payments that are tied directly to production. Normally, our government programs aren't tied to production, but these have been. They've been directly tied with production, incentivizing people to produce more milk for that unknown of a government program going forward. So does that change what you're thinking in terms of a reduction in domestic milk production going forward if we see a continuation of these programs, these ad hoc programs, at least maybe for another couple months? Do you think we'll see those programs?
Yeah, good question. My assumption is, yeah, I don't think we're going to see a lot more. I think, you had the initial COVID, bill back in the spring that put a lot of money out into agriculture, a lot of money into dairy. The second, round of that, the payments are going out. Was it CFAP or whatever? I think that's about it. I don't think there's much more beyond that. Like I said, agriculture got a lot of money. I think, the Trump administration is, probably generally more favorable to that. And, coincidentally, it was an election year when politicians tend to push a lot of money out anyway. So I don't think there's going to be a lot of new cash coming in. I think the benefit from that is going to be, as I mentioned about, deferring milk checks, is that a number of farms, particularly small farms and mid-sized farms in the middle part of the country and eastern half of the country, will have a pretty good cash cushion going into next year, which is going to help kind of get through some of the tougher months early on. So by the time we got to next spring, and I think by second quarter start seeing some higher prices in the mid-year, that we're not going to lose as many cows and farms as maybe without having that big cash pile to move to come into next year with.
Okay, thanks. And then another question, kind of also staying on the policy side just a little bit, but we had an attendee ask, if the federal food box program would have bought more butter and possibly cheese, would we have seen the large negative produced price differentials that we saw? The October producer price differential for federal marketing order 33, which is the Ohio one, had a negative $6.87 producer price differential for October.
Yeah. So if they would have bought less cheese, the answer would be yes, because you wouldn't have had a higher class 3 price. I don't know if they could have bought enough butter to matter. I think they bought 15 million pounds in one of those rounds. They need to buy like 100 million pounds. That's too much butter we have. So I don't think it would have been able to make that much of a difference. And I'd say in general, I know what Mark talked about here a week or so ago, but in general, negative PPDs aren't necessarily a bad thing. They look bad on your check, but the reason it was negative because you had a really high class 3 price, so you got more money for your milk relative to everything else. So I think it would have been less, but not zero.